Hello, everyone, and welcome to the latest Markets Monthly Strategies and Perspectives for September 2024. As always, my name is Gary Quinzel. I am the Vice President of Portfolio Consulting at Wealth Enhancement, and I'm joined by one of our senior portfolio managers and consultants, Yoshioka. Let's go ahead and dive in. Let's talk a little bit about what just happened most recently in the market. It's been a little bit of a bumpy ride as we finished up the summer and we entered into September, which historically has been somewhat of a down month. That we had a little bit of a downward spill to start off August. A lot of that was predicated upon some technical factors. There was an unwind of a yen carry trade, which created some volatility. There was a period where some of the bad news coming out of the economy scared some market participants into thinking that we were actually going into a recession. So we got a little bit of a sell-off. In fact, some markets actually reached that right around that minus 10% kind of correction territory. But just as soon as it happened, markets rebounded quite strongly. We saw a pretty strong finish to August as we turned the corner into September, which, as I mentioned, has historically been a little bit of a rocky month. Now, all the focus, and we're going to talk more about this in a little bit, has been all about the labor market. So the Fed, as we know, has been very, very laser focused on inflation for the last several years. We had historically high inflation. The Fed has been very focused on stemming that inflation, which is why we had that historically fast rate hiking cycle. But now that attention has kind of shifted, and the Fed and market practitioners everywhere are really focusing in on what's happening in the labor market. And as we witnessed, the unemployment rate is now at 4.2%, which historically is still relatively low and healthy relative to history, but it has moved up notably. And sometimes it's not a matter of the level of unemployment or the level of any statistic, it's the rate of change. And because it's moving in that higher direction, that's what's got people a little on edge. But inflation does appear to continue to be moving in that right direction. Certainly optimistic from our standpoint. Though we've seen some isolated upprints in inflation, for the most part, we are continuing to see progress in that direction. And so the summary of all this is that the upside risk seems more heavily skewed towards unemployment than it does to inflation at this point, which is why the Fed recently came out and made a bold, decisive move to lower interest rates by 0.5 percentage point. Going into that most recent meeting, there was a lot of debate about whether the next cut would be 0.25% or 0.5%. Well, we finally know the answer. The Fed came out and made that decisive move, and here we are. We are now easing interest rate policy as opposed to tightening, and it'll be interesting to see how the markets go from here. So let's go ahead and dive in a little bit and talk about what happened in the market in the month of August. Aya, go ahead.
Thanks, Gary. Appreciate it. So in August, as Gary mentioned, we started out the month a little bit rocky, but you can see from this chart everywhere except for the small caps ended the month in the green. So that was one nice thing that we saw from the month of August. Small caps have been a little bit more volatile. They've been a little bit more sensitive to the moves in interest rates and growth expectations. So they trade on both just as much as anything else. And so as the rate expectations, for the expectations for rates to come down increased, they did really well, especially in July. However, they sort of entered August with a little bit more volatility, just as the overall market had that volatility. In terms of fixed income, again, we saw those yields come down. So Treasury yields came down, expecting rate cuts in the fall. And so we're seeing that be a positive to the overall fixed income market. As rates come down, prices for bonds go up. And so you see that return for bonds being positive in the month of August. If you go to the next slide, speaking to the volatility that we saw even in the early first week of September, in which we saw, I think every day in the first week of September was a down day in markets. And so, this really honed in on the seasonality that we tend to see in September. The last 5 years on average has seen the S&P 500 down 4.2% in the month of September. But as you can see in October, November, and December, you can see some of that rally back. Some of that has to do with earnings that will begin in October. This year is an election year, and so September and October tend to be a little bit more volatile from a seasonal perspective. But again, after the election occurs, we tend to see some of that volatility lessen. If you go to the next one, yeah.
Is it fair to say that the blackout period affiliated with the earnings cycle also might have something to do with the historically negative returns in September?
Absolutely. I mean, as we go through the end of, the last couple weeks in September and into the first couple weeks of October, there is that blackout period in which, companies aren't able to talk about, what has occurred with sales and earnings over the last quarter.
Yeah, and I think I saw that, just the buybacks, the decrease in flows from decreased buybacks really has an impact. And for whatever reason, from a seasonality perspective, in this quarter, it seems to have just this cycle of being more impactful. So really interesting that we've seen this occur on such a repeated basis. Sorry to interrupt. Go ahead.
Oh, no, absolutely. It's great. And so one of the things that I think we want to always point out too is changes in the fixed income market. And this was a big one. So, the yield curve, the difference between the 2-year and the 10-year maturities in treasuries had been inverted, right? Meaning that the 2-year yield was higher than the 10-year for, the last almost 500 sessions, I believe, in markets. And, it's been the longest inversion of the yield curve in the last 50 years. And we just saw this go positive. So we now see the 10-year actually yielding more than the 2-year. And that does reflect the fact that the 2-year is reflecting the expectations for Fed cuts. And so we're going to start to see this normalization in the overall Treasury yield curve, which is a positive.
Yeah.
And yeah, any comments, Gary?
No, I was just going to say it's interesting because it shifts the opportunity set. And so, for all these past few years, we've been taking the low-hanging fruit about the attractive yields for low risk right in front of us. But, as longer-term investors, we want to look for yields that are more durable, right? And that's where we start thinking more about duration. And so we look for opportunities further out on the yield curve where it is, in fact, steeper, and that presents more opportunities. So I think we're now at around 17 or 20 basis points on this chart, as of mid 2/3 of the way through September. So it will be really interesting to see how that continues. Of course, the yield curve, is still inverted on a 3-month to 10-year basis, but it does seem like, if we continue on this trajectory of cutting rates, that in fact will be more steeper as well. But great observations. I'm going to talk a little bit about some economic observations before I hand it back to Aya. But as I talked about earlier, the labor market continues to be the focal point of the Fed, and for most economists that are just kind of figure out, are we in fact going to go into a recession? We've been talking about this for many, many months now. We do not see a strong indication that a recession is imminent, but there is clear data that the labor market is in fact softening. We've had multiple labor numbers, job reports come in softer than expected. We can see that downward trajectory on this chart. And once a year, they also do an annual revision, which we've talked about in the past. And so they revise the overall payroll numbers lower by over 800,000 jobs, which, in the grand scheme of things is not a huge number. And there is some expectation that they're going to revise that number back towards a lesser number, a more positive indication. But it just does demonstrate the same thing that the Fed is focused on. They're trying to step in and save the labor markets actually before it becomes an issue. We're still creating jobs in the economy. The economy is still putting out positive growth numbers overall, but we see the trend. And as I mentioned earlier, the risks to unemployment do appear higher than they are to inflation. But if we look at some other things that are really interesting if we're thinking about, how is the typical consumer doing? Well, there's a lot of different ways we can look at that. So overall, retail spending was pretty strong as of the most recent number. But how much money are people stashing away? How much money are people putting into money markets or, saving for a rainy day? And so what we can see here, there's a few different lines here. And the top line represents what the top income earners are doing. And the bottom line represents what the bottom income earners are doing. And as you can see, that gray line is actually dipped into negative territory, which basically means that the bottom income earners are being stretched further, and that makes sense because inflation hit them harder. They're the ones probably losing the majority of the jobs that are being lost. The top earners are doing just fine, and then the middle also following the same trajectory, but a little worse than it was a few years ago. So this is something that I think probably has more of a social or political impact than it does market impact. As important as it is, we think that, from a factual standpoint, the top income earners, of course, are going to drive the most in terms of spending, which of course translates into corporate earnings and corporate profits and higher prices for stocks. But as we are in an election cycle and season, these things do come out to play in terms of the overall tone and pulse of the economy. And the fact is, we can clearly see a notable decline for those bottom income consumers. And another thing that we look at often is, are people stretched from a credit card perspective? And so we can see from this chart that credit card delinquencies, yes, they've actually come up a little bit since 2022. But if you look at it on a much larger scale, from some broader context, we can actually see that they're still very, very low overall, which is certainly a positive thing. And a lot of times it doesn't actually spike until you have a notable uptick in unemployment, which is why we are watching it so very, very closely. And so all of this in summary, I know I is going to talk a little bit about where GDP is right now or where we think it's going to go, but it sums up to think that, GDP or the economy is probably slowing down a little bit. But I don't know, you think, is there any indication that a recession is imminent? I already shared my 2 cents.
Yeah, no, definitely the soft landing narrative continues to be in place. And just talking about the consumer and credit cards too, with the Fed lowering interest rates, that should help out those consumers who are sort of delinquent, having to pay back at higher interest rates, right? Those interest rates on credit cards can be pretty burdensome, and so having interest rates overall come down over the next year or so should also help out consumers. But going back to the economy and GDP, we do see, again, as you mentioned, with retail sales coming in better than expected. I always say never bet against the U.S. consumer. We all know how to spend. We're all really good at it. So, and we see that continuing to come through in the GDP numbers and domestic final sales. And so even though we did see some softness in some manufacturing numbers, services continues to hold up. And again, retail sales continue to be holding up as well. And that all contributes to a healthy GDP number. So we continue to expect that to remain in this 2 to 2.5% level. The other thing that we look at too is credit spreads. And so, what this means is, for corporations who need to borrow, what type of spread is the market asking for above, treasuries, right? And so high yield corporations, these are bonds in which maybe the company isn't as in a great position from a balance sheet perspective as some others, but an investment grade is a little bit more higher quality, right? And so these are spreads relative to treasuries. And as you can see that during times of uncertainty, these spreads sort of increase. And you could see that during the early parts of August. That's that purple and blue spike, but you could see how quickly they came back down. And that's another indication of how, underlying information and data show that things aren't that bad as markets tend to react to, at least on a short-term basis. The other thing, and I know this is a really simple thing, but we debated about whether or not there was going to be a 25 basis point cut or a 50 basis point cut and what that would mean, and whether or not a 50 basis point cut really means that maybe the Fed was seeing something in the data that indicated a potential for recession, and therefore that's why they were trying to cut a little bit more than just the 25, because the data does show that again, the economy is holding up. And so this is a great chart. I thought when the Fed does cut, again, it's pretty simple, but if there is no recession, the markets tend to continue on. It's great, right? There are no issues. But when there is a recession, this is where you see the impact, even though everybody's been expecting and hoping for these Fed rate cuts. If we do get a recession, it's problematic. And so that's why everybody's so laser focused on all of the economic data that continues to come out. And with that, I'll hand it back to you, Gary.
Thanks, Aya. So just to wrap things up here, I think in summary, we from our perspective, the U.S. economy, it's continuing to expand, but just at a more moderate pace, and that's okay. We still see opportunities really across the globe. I think right now the U.S. does appear to be one of the more interesting places because of some of the geopolitical uncertainties that are out there. Obviously, there's a lot going on in the Middle East, some horrible things, and same thing with the ongoing wars in Russia, Ukraine and Russia. But overall, we do continue to have a cautiously optimistic outlook. It's really the focus right now is going to, on a go-forward basis, is going to be focused on the Fed and what does the Fed continue to do, and are they going to shift their verbiage, and are they going to shift their approach and they're going to do so based upon the data that comes in. As of today, or late September, I should say, they are talking about potentially one or two more cuts this year. I think that's being priced in. So the overall magnitude of what they're ultimately going to do is going to be dependent upon what the labor data says, what the growth data says. And so there is going to be some fluctuation and volatility as we approach the election season. And we talk a lot about the outcomes of the elections and how much they matter. From our probably oversimplified vantage point, the most extreme examples would be a swing in either direction. If we saw a full sweep of one party, full sweep of the other party, then you could actually see some significant policy changes. But it does appear more likely that there will be some sort of mixture of government running Congress and the White House come November. And so that would probably be a best case scenario for the markets, which historically have prevailed under any scenario of who's running the show. So we advise all of our clients, to embrace volatility. It's part of a normal market cycle. It's going to happen. Use it to your advantage for dollar cost averaging, putting cash to work. Take advantage of low correlation strategies where they are appropriate, and take advantage of the steepening yield curve and embrace duration. And if you have questions about any of these strategies, speak with your financial advisor. They'd be happy to explain more about investing over the long run and how to embrace uncertainty. With that, we hope you enjoyed today's episode of Markets Monthly, and we hope you join us on future ones. Thank you so much.